The surface of the economy looks bulletproof. The stock market is pushing all-time highs, and retail traders are waiting for the next tech stock to take off. But beneath the veneer, there are deep cracks forming in the foundation. We are watching the world's largest economy go through a violent midlife crisis, fueled by trillions of dollars in spending we don't actually have. This is a visualization of $38 trillion in national debt. This specific glowing slice represents $1 trillion, the amount of capital the United States government sets on fire every single year just to service the interest on that debt. This pays for no infrastructure and no defense projects. It is simply the annual price of keeping the debt collectors off the front lawn. This balance sheet view shows a government that has been wildly unprofitable since 2001. We are currently running a deficit of nearly $2 trillion. Every year, Washington spends $2 trillion more than it collects in tax revenue, creating a systemic risk that makes the 2008 financial crisis look like an accounting error. To bridge that gap, the government borrows the difference, doubling down on a losing position to avoid a margin call. We are printing our way out of the present while entirely shorting the country's economic future. The interest on that borrowing has skyrocketed, rising 34% in just the last 2 years. Ending this cycle requires a radical shift in the budget. We have to find exactly $2 trillion to cut from annual spending before the current trajectory reaches its breaking point. When the public demands a balanced budget, the immediate target is usually foreign aid. The common belief is that eliminating these overseas payments will magically fix the deficit. This bar chart compares the $78 billion in foreign aid against mandatory domestic spending. In reality, foreign aid is barely 1% of the entire federal budget. If we completely zeroed out foreign aid today, the savings would fund exactly 19 days of Social Security payments before the vault was empty again. This pie chart reveals the rigid structure of federal spending. 70% of the budget is locked into just 5 untouchable categories: Social Security, Medicare, Medicaid, national defense, and the net interest on the debt. Everything else is a rounding error. Looking at these categories side by side, it's clear that finding $2 trillion requires gutting either the national defense budget or mandatory entitlement spending. In Washington, executing either of these options is considered political suicide. Consider the defense budget first. It sits at roughly $850 billion. The United States spends more on military power than the next 10 nations combined, including rivals like China and Russia. But no elected official will risk their career to be the one who weakened American power in an era of escalating global proxy wars. This makes significant defense cuts an impossibility in the current political climate. Because cutting military power is a non-starter, the remaining path requires the politically radioactive option of cutting mandatory spending. Social Security, Medicare, and Medicaid are the true giants of American finance, devouring $3 trillion every single year, 44% of the entire budget. This graph displays the projected health of the Social Security Trust Fund. The system is bleeding out, mathematically projected to go insolvent by 2034. When the fund runs dry, benefits can only be paid from ongoing tax revenue, triggering an automatic 20% cut to every single recipient. Logical fixes exist, such as lifting the Social Security tax cap to tax high earners on their full income. This would close 73% of the long-term funding shortfall instantly. But policy is consistently written to protect the wealthy, leaving the eventual burden on the beneficiaries. Medicare faces a similar crisis, costing over $850 billion annually. Its hospital insurance trust fund is set to hit insolvency even sooner, in 2033, triggering automatic 11% cuts. Billions are also lost to the private sector. Medicare Advantage plans are estimated to be overpaid by upwards of $127 billion every year. Fixing these overpayments could save $2 trillion over the next decade, but the health insurance lobbies are too powerful to challenge. The insolvency dates are fixed, and the deficits are accelerating, but the decision-makers are paralyzed by the political cost of reform. They prefer to let the system ride on autopilot toward disaster, praying the inevitable crash happens on someone else's watch. For decades, the United States assumed foreign central banks and institutional investors would endlessly buy our debt. We ran the world's most aggressive financial operation on the assumption that global demand for our bonds was infinite. But global liquidity is tightening. When investors look at a nation borrowing trillions with no viable roadmap for reform, they demand higher yields to compensate for the extreme risk. The moment bond auctions fail to attract buyers at current rates, interest rates will spike violently. A spike in sovereign yields bleeds into the real economy. Mortgage rates double, auto loans become toxic, credit lines freeze, and the debt bubble violently bursts. The government faces two outcomes: default on sovereign obligations, or print trillions to monetize the debt. Monetizing the debt would intentionally trigger severe inflation. This path vaporizes the purchasing power of the middle class, effectively liquidating their savings to pay off the government's creditors. We have built an empire on the illusion of infinite borrowing. While the public is distracted by stock market highs and superficial economic data, the smart money is already hedging for the shockwaves. When the debt spiral reaches its absolute limit, the insiders will have already protected their capital, leaving the everyday citizen to hold the heaviest financial bag in history.